Okay, so first things first, we have to define these terms. Okay, investment, required rate of return, expected return, arithmetic mean, geometric mean, equity, bonds, and financial risks. These are very important terms in this course. All right, so it's very paramount that you understand what each of them means. Now, some words we've come across them. Okay, so I would expect to also hear some answers from you or what you understand from these words. Okay, so the first term that we're going to go through is investment. Colleagues, what is an investment? I believe all of us here have invested in something before, okay, whether it be a house, a car, right? What is your understanding of an investment? Yes, yes, that's correct. That's actually very correct. Okay, when you put money, especially when you buy an asset, okay, so that you can earn returns or interest over some time. Okay, also that asset which you buy, okay, sometimes it might not earn any returns, but it can help also the business operate well, right? But usually it's whenever you buy an asset for financial gains in the future. Yes, madam. Okay, so here are some type of investments that we're going to be seeing here. Okay, investments, shares in a company. All right, remember, if you buy shares in a company, you become part owner and you'll be entitled to dividends from the company. Okay, another investment is bonds. Okay, bonds are also traded like shares. Okay, if a company or a government needs money, they can issue out bonds. Okay, government issues out the treasury bills, treasury notes, and treasury bonds. Okay, this is also an investment because you'll be earning interest. Okay, shares you earn dividends, bonds you earn interest. All right, real estate property. All right, you buy it, then you resell it for a higher price, or you rent it out, and then the returns that you'll be getting is the rent. Okay, so which brings us to an important concept. Because remember, this course is investment analysis and portfolio management. So investment analysis, basically we're trying to see where should we put our money. Okay. Then colleagues, what do you understand by a portfolio? Okay. Anybody? Has anyone ever come across this term, a portfolio? Okay, portfolio is a group of investments, all right? You buy shares in three companies, you buy bonds from three different companies, you buy treasury bills from government. So it's more like a collection of investments, basically. Remember the saying, do not put your eggs in one basket? That's the purpose of a portfolio. If you buy shares only in one company, if that company does bad, you don't get any dividends or any interest payments. So you want to spread out your risk, okay? So that if one company is not doing bad, I mean, if one company is doing bad, at least you can get returns from another company. Okay, so basically, investment analysis and portfolio management is deciding where to put your money and then managing your investments so that you're balancing out the risk, okay, and at least you're getting your returns. That's in layman's terms. Any questions, colleagues? So these notes, I'll send them to you where I've put some examples. Okay, you can go through those examples. All right. Next is the required rate of return. So basically, here what I'll ask is when you hear the word return, what comes to your mind? Remember, in my classes, I like to have a dialogue so that we all learn from each other. Okay, colleagues, we'll all learn from each other. You might have a good definition that no one has heard of, and we can learn from each other too. Yes. So when we hear the word return, what comes to our mind? Yes, profit. Basically, it's just money coming from an investment. Okay. So when you hear the required rate of return, what can you say that is in layman's terms? Because remember, if we can say this in layman's terms, then we were okay. No textbook definitions here. Okay, we want in layman's terms. Yes. So when you hear the word required rate of return, that's correct. Yes. The minimum profit that you expect to get from an investment. Anything lower, you are not investing in it. Anything higher, you invest. Okay. It's like a benchmark that you've put. Okay. So if you want returns of 10%, and then you see certain investments are giving you returns of 7%, 6%, you won't invest because you are expecting 10% return. Okay. Yes. You see any investments giving me 13%, 12% above there, you invest in that because that's the return you want basically from your investment. So that's the required rate of return, the minimum return you expect to get from an investment. It's like the benchmark you make. Okay, think of it as a benchmark and say anything lower, I am not getting. Anything higher, I am going to get. Are we okay with that, colleagues? Any questions? Okay, there are some factors that can affect the return. All right, risk level. Okay, the basic rule for every investment is if you expect higher returns, or if there's a high risk involved, okay, high risk of you losing your mind, you should expect higher returns. Okay, if there's a low risk involved in that investment, then expect lower returns. Okay. Because as people, whenever we invest, most of us were conservative. We don't want to lose money. Okay, so we want investments with low risk. Okay, like treasury bills. All right, those because it's government who is issuing them out. Since it's government issuing them out, there's a lower risk that you might not get your money back. Remember, government is the one that prints the money, so there'll be a lower risk that you might lose your money. So the risk level has an effect on the return. The higher the risk, higher return. The lower the risk, the lower the return. Are we clear with that, colleagues? Okay, wonderful, wonderful. Inflation. Okay, inflation erodes your returns. Okay, if you're expecting a 10% return and there is inflation of 7% that year, in reality, you're getting 3%. Okay, remember inflation, the increase in the price level of goods and services. Inflation affects the purchasing power of money. Okay, so your return is money. Okay, so if your return was 1,000 today, after 2 years, that same 1,000, right, it can't buy as many goods as it could 2 years prior. Okay, so inflation is one factor to consider, especially when you're talking about returns. If you ignore inflation, then your returns are going to be eroded. Okay, because as the inflation rate goes up, your returns go down. So that's what you must remember, colleagues. The inflation rate goes up, returns are going to go down. Okay? And I believe in macroeconomics, you learned about real and nominal returns. Nominal, where you don't adjust for inflation, real, where you adjust for inflation. Okay, whenever you hear the real interest rate, okay, that's the interest rate that is adjusted for inflation. Okay, you're taking account for inflation. But if you hear the nominal interest rate, you haven't accounted for inflation. Okay, sorry, colleagues, I was kicked out. What was I saying last before I was kicked out? Yes. Okay, so, yes, real interest is the interest adjusted for inflation. Okay, if let's say, for example, the interest rate is 10%, and the inflation rate, so let me distinguish the I's since both of them start with I's. The interest rate is 10%, then the inflation rate is 3%. To get your real interest rate, we just subtract the inflation rate from the nominal interest rate. The nominal interest rate in this case is this 10%. Okay, this 10%, we haven't accounted for inflation. Okay, so if we want to get our real interest rate, we just subtract inflation. 10 minus 3, 7%. So after you adjust for inflation, your return is going to be worth 7%. Any questions? That is just the simplified formula there. It's a complicated formula, but you still get the same answers. Yeah. Alternative investments. Okay. If there are alternative investments that are giving a better return than a required return, you go for the alternative. But if the alternative investment is giving a lesser return than your required return, you ignore it. So if your required return is 10% and another investment is offering a return of 3%, ignore. But if another investment is offering a return of 15%, you're going to go for that investment. So these are the factors that can affect your required rate of return. Okay. The next one is expected return. Colleagues, anybody? Expected return? Basically, the return you expect to get on an investment based on past data and trends. Okay. You are going to attach probabilities to certain returns. Okay. And then you're going to tabulate an estimated. This is just an estimate. Okay. It's just an estimate. Sometimes it can be wrong, sometimes it can be true, it can be higher or lower. But this is an estimated return that you tabulate based on past information. Okay. And this is how you get your expected return. Okay. You are multiplying the probability multiplied by the return for each investment. Okay. So let me just illustrate this numerical example here. Right. If a stock has a 50% chance of giving you a 10% return, so this is the probability, and a 50% chance of getting a 10% return. So this 50% is your probability, this 10% is the return, okay, in year one, and a 50% chance of giving you a 5% return in year two. So again, we have another probability, 50% to get a 5% return. Okay. So you want to find out, okay, so what is the expected return for this investment? This can be shares, okay, this can be bonds, various investments that you'll be dealing with. Okay. So what you're supposed to do, as this formula states here, you're just multiplying the probability with the return attached to that probability. So this 50%, multiplying it by 10%, plus this 50%, multiplying it by this 5%. All right. So these percentages, we convert them all to decimals. Okay. So 50% is 0.5 as a decimal, 10% is 0.1. Okay, this is for year one. Then this other 50% here, this is 0.5. This 5% converted to a decimal, 0.05. Okay, so 0.5 times 0.1. Let's get out. Oh, it's 0.05. Okay. Then 0.5 times 0.05. Okay. 0.025. 0.5 plus 0.025. Yes. Okay, zero. which when we convert into percentage again is 7.5%. Okay. So basically what is this telling us is that if you invest in this stock or this share for this company, expect a return of 7.5%. Okay. That's what you should expect basically. You might get something higher, you might get something lower, but it's giving you an idea of where your position basically if you invest in that stock. Any questions? And also expected return, you can also just think of it as the average return also. Okay? Just that this time you're just attaching probabilities. Any questions before we move to the next one? Okay, so we've got two. I want to talk about these two side by side: arithmetic mean and geometric mean. Okay. Now both of them they're also averages. Okay. They're basically just telling you the performance of an investment. Okay, but they differ. Okay, the geometric mean takes into account compounding. What we mean by compounding is how each return affects the return the next year. Okay, we're taking account for those fluctuations. We're saying that the return you get in year one is going to have an effect in year two. The return you get in year two have an effect in year three, and so on and so forth. That's what the geometric mean does. But with the arithmetic mean, you are not taking into account compounding effects or how the yearly returns are affecting each other. You're just thinking of them as independent. Okay. So, for example, let me illustrate this. So, for example, maybe let's say you purchase a stock and you have these returns for these certain years: year one, year two, year three. All right. So, in year one, maybe say you get a return of 30%. In year two, you get a return of 40%. In year three, you get a return of 20%. Okay. So if they ask you calculate the arithmetic mean, all right? Remember the arithmetic mean, you just add and divide by the number. Okay, so you just say 30 plus 40 plus 20%. That's 20. Divided by 3. Since there are 3 years, so we're dividing by 3. Okay. 30 plus 40 plus 20, that is 90. 90 divided by 3, 30%. Okay. So that's your average return. Okay. So basically what it's telling you, it's simply like, it's just like saying that every year you're getting 30%. Year one, you get 30%. Year two, 30%. Year three, 30%. When you total them up, it will give you, why is this thing doing this? That's hold on, colleagues. This thing is needs to be refreshed. But when you add up 30 plus 30, you get this 90% which we calculated. All right. So the arithmetic mean is not taking into account how each of these returns are affecting each other. Okay. If I move any further, any questions? Hello? Are you able to get me? Hello? Can you hear me? Sorry about that. Was kicked out. The weather today. Where was I kicked out from? Okay, 30%. Yes. So what I was basically saying is this 30%, which is our average return, okay, is simply saying that in year one you got 30%, in year two you got 30%, in year three your return again was 30%. Okay. That's what it's translating to basically. Okay. When you this arithmetic mean, okay. It's like each year you're just getting 30% on average, basically. All right. When you add these 30%, they will give you this 90% we tabulated earlier on. When we added 30 plus 40 plus 70, we also got 90%. Okay. So it's just basically showing you the performance of your returns, basically. Okay. This is how much you're getting on average on a yearly basis. But it does not take into account how these returns affect each other. Okay. It's just saying in year one, that 30% is independent. Year two, that 40% was as independent. Year three, that 20% is independent. Okay. Now, with the geometric mean, okay, we're going to account for the fluctuations here, how each year is affecting the next year, basically. All right. That's what we mean when we say the geometric mean takes into account compounding or fluctuations, basically. We're taking into account how each year is being affected by the other year. Okay, like here in year one to year two, we had a 10% increase. Year two to year three, we have a 20% drop. Okay, so to get our geometric mean, okay, which is the more reliable mean because it takes into compounding into effect. Okay, because the returns you get from from shares, okay, they are all interconnected because certain things can make the share price go down and the returns go down. Certain things can make the share prices go up, especially like how basically how the company is performing. The company is performing well, share prices will go up, returns will go up. Company is performing low, returns will go down. Okay, and share prices will also go down. So the geometric mean, this is the formula, pi to the power 1 over n. Basically, what it's just saying is we're going to multiply these returns and raise them to the power 1 over the number of years. Okay. So we're going to say 30 times 40 times 20 to the power 1 over n. N in this case is 3 because there are 3 years. Okay, so n is 3. So colleagues, let's get our calculators. 30 times 40 times 20. Okay, 24,000. Okay, on your calculator, if there's the cube root, get the cube root of 24. Because this 1 over 3 is the same as just saying the cube root of 24,000. Now, if you don't know where the cube root is in your calculator, okay, what you can do is this. You just say 24,000 to the power 1 over 3. Okay, just do 24,000 to the power 1 over 3. Okay, you type in 24,000, then to the power 1 divided by 3 to give you the same answer. Okay, what values are we getting? I want to make sure everyone has put it in. 24,000 to the power 1 divided by 3. I'm getting 28.84%. Are we all getting 28.84? Are we all getting 28.8? So you can see the geometric mean is lesser than the arithmetic mean. Why? Because the geometric mean took account of the fluctuations that happened. Okay, took account of this 10% growth from year 1 to year 2 and this 28.8. Did you get 28.8? Okay. So as I was explaining, the arithmetic mean did not take into account these fluctuations here. It was just taking So just assuming that each return is independent, it's not affected by the previous years. But the geometric mean took into account that there was a 10% increase from year one to year two, and then there was a 20% drop from year two to year three, right? And that's how we get our geometric mean of 28.8%. So the geometric mean is more reliable, colleagues, okay, especially for monitoring growth and fluctuations in an investment. It is more accurate, and you'll see the geometric mean being used more often than the arithmetic mean. Okay, the arithmetic mean for short periods, yes, maybe 1 to 3 years, like how we've done there, arithmetic mean is okay. But you'll notice if the number of years grow, if I increase the number of years, these two figures would have been they would have been different. There would have been a gap. Okay. Then the geometric mean is for longer years. Okay. 3, 4, 5, 6, 7, 8. As you go more years, you want to find out, okay, what's my average return here? We'll get the geometric mean. But both are just tracking performance of your investment. Okay. It's just that arithmetic mean doesn't take into account compounding, how the investments affect each other on a yearly basis. And the geometric mean takes into account compounding, how these returns affect each other on a yearly basis. Any questions? Okay. I've got a class at 21, so let me just run through the remaining terms. The next time we meet, we'll start the calculations part. Okay, because I can see in the calculations part, there will be some parts where you need expected return. I think even arithmetic and geometric, but yeah. So equity, basically ownership in a business, all right? Types of equity, common shares or ordinary shareholders. These are the ones who have the voting rights and get paid dividend. They're not entitled to dividends on a yearly basis. Okay, ordinary shareholders are not entitled to dividends. Sometimes they might not get paid. Okay, then but they have voting rights. Those are the ordinary shareholders. Okay, then you've got preference shareholders. These ones have no voting rights but are entitled to a fixed dividend. Okay, these are the two types of equity for a business, for a company. Okay, common shares, ordinary shares, and preference shares. You see this for companies. But for a sole trader, it's just owner's equity. Okay, how much you put into the business. All right. But just remember, equity translates to ownership. Bonds is a loan you give to a company or government and you get some interest payments. All right. There's a topic on bond valuation in this course, so we're going to go deeper into that. But yeah, that's what the bonds are. Loans you give to companies or government. When you purchase that loan, okay, it's going to, most of them will have a maturity date. Okay, so if the maturity date is after 5 years, okay, if you purchase a bond, let's say you purchase a treasury bill and they tell you it's maturing after, actually, treasury bills, it has to mature within a year. Let's say a treasury note. A treasury note matures between 1 to 5 years. Okay, purchase a treasury note. As you're waiting for that bond to mature, you'll be receiving interest payments in those 5 years. All right. Then when the fifth year reaches, you're going to be given your final interest payment. Then you also be paid the amount printed on the bond, which is called the face value. Okay. bonds and shares have a face value, just like a 100 kwacha note. Okay, on the 100 kwacha note, you see that 100 kwacha, that is the face value. On a 50 kwacha note, you see that 50, that is the face value. Similar with shares and bonds. So with bonds, what the face value is what you're going to be paid when the bond matures. And as you're waiting for the bond to mature, you'll be receiving interest payments. Then finally, financial risk. All right, basically the chance of losing money. Okay, because as you invest, it's not always you're going to make money. There are possibilities that you're going to lose money. And this is what we call the financial risk. So, colleagues, we can pause here for today.